So learning objective 3 picks up where learning objective 2 left off, right? So the last budget that we went over was for direct materials. So as you know, in the manufacturing process, we still have to do direct labor and manufacturing overhead. Okay. So those are the first two budgets that we're going to look at here in objective 3. Direct labor budget is actually pretty straightforward. It makes a lot of sense, right? Based on the units you know you're going to have to make and the amount of direct labor time that you need to make each unit, you multiply that by the cost of that labor per hour, and there's your total direct labor costs in a nutshell. So this illustration is important to know, and I think it's pretty straightforward to understand. How a direct labor budget looks like here in this objective is also quite basic. So here's the illustration here. We're still at Hayes Company. You're probably getting used to that company by now. So here we need 2 hours of direct labor to produce 1 unit of whatever it is that we're making. I forget the name. And the wage per hour is $10 an hour. Mhm. So based on the budget here for direct labor is based on what we're going to be producing every quarter, right? So we have to go back to illustration 9.5, which is our production budget to find out what we're going to be producing. We multiply that by the number of hours per unit, which, as it says here, it's 2 hours of direct labor per unit. So that gives us the total number of labor hours that are going to be required, and that each of these labor hours are at $10. And so your direct labor costs are calculated in this way for each of the quarters. Again, all of this is based on your production budget, right? How much it needs to be produced. So we got quite a lot of labor to budget for, $308,000 for the year in our direct labor budget. Illustration 9, important. Not to be overshadowed, we need to figure out manufacturing overhead. And of course, you know that that overhead is either going to be fixed or variable costs, although there are some mixed costs as you learned in the other chapter as well. But in this case, we're going to stick with Hayes, and we're going to keep it simple. All right. First thing, variable costs are going to fluctuate with production. Right. So these are our variable costs per direct labor hour. For every labor hour we need indirect materials for $1, indirect labor at $1.40, utilities are 40 cents, and maintenance is 20 cents. Okay. So thus, for 6,200 direct labor hours, that produces 3,100 units. We are going to be budgeting indirect materials, that's this here, at $6,200. That's 6,200 hours times this dollar per hour. And your budgeted indirect labor would be the 6,200 hours at $1.40 per hour. So that's $86.80. Okay. Hayes also recognizes that some maintenance costs are going to be fixed and the amounts are going to be assumed in this budget. So what does the manufacturing overhead budget look like? Variable costs will be listed first, again, based on the number of labor hours, which is your previous budget, right? Illustration 9.9 that we just went through gave us all the direct labor hours that we need to base this thing on. So again, based on that indirect materials at $1 an hour, indirect labor at $1.40 an hour, utilities at 40 cents an hour, maintenance at 20 cents an hour. times that 6,200. And here you got your total variable costs in the first quarter to produce those units. And then they've given you a series of fixed costs, as you see, do not change over any of the periods because it's not based on the units of production, right? So we have supervisor salaries, depreciation expense, property tax and insurance expense, maintenance costs, etc. $38,500 is the fixed costs for each of the quarters that are listed. So then your total manufacturing overhead are the variable costs for that quarter plus your fixed costs for that quarter. And so for the first quarter, we will need to budget $57,100 of manufacturing overhead. For the second quarter, of course, it's based on a higher level of labor hours. And so your variable costs are going to be higher. Your fixed costs are going to be the same, right? Again, your third quarter, more labor hours. That's going to calculate into higher variable costs, but fixed costs are going to stay the same for your total. And that very last quarter, we're using significantly more labor hours. Again, higher variable costs. Your fixed costs are steady for total manufacturing overhead. So these totals here for each of the quarters would be added up to $246,400 in overhead. That is for 30,800 direct labor hours that's these four numbers hours total together. And so per direct labor hour, your overhead rate is $8 per direct labor hour. The total of 246,400 divided by the number of labor hours. So per hour, $8. So that's important. This particular slide goes over and introduces you to the fact that, again, your selling and administrative expenses are also needs to be budgeted. Okay. So some things that we have a projection of what the anticipated expenses are going to be, and very much like the other budget that we just looked like, we do distinguish between fixed and variable costs. So here we go. The variable expenses rates per unit of sales are $3 for commission and $1 for freight out. So that's your shipping. So that's going to be the variable expense per unit of sales. Right? So that's the variable part. Variable expenses per quarter are based on the unit sales from the sales budget. So based on what the sales budget has, these are very important to know. Again, Hayes expects the sales in the first quarter to be 3,000 units, and the fixed expenses are given to you on assumed data. So the selling and administrative expense budget is going to be listed next. Again, by quarter, it's based on your budgeted sales. So $3,000 worth of, 3,000 units of sales, right? Well, your variable selling administrative expenses are going to be sales commissions per unit and freight per unit. So if you're selling 3,000 units, you'll have 9,000 of commission, and you'll have 3,000 of shipping and freight costs. So your variable expenses based on 3,000 units of sales, 12,000. All your fixed expenses, again, you're going to see these numbers all the way through. They are fixed, $30,000 per quarter in fixed expenses. So those two added up will total $42,000 in selling and administrative expenses. And again, same thing happens in the second quarter. They're selling more units. So again, if it's $3 a unit, you're selling more units, you'll have a higher sales commission budget, you'll have a higher freight budget, and your variable expenses will be higher. Your fixed expenses are going to be the same. Same thing here. In the third quarter, you're selling 4,000 units. So those variable expenses are going to increase based on that, but your fixed expenses are going to be the same. And in the fourth quarter, yet you're selling even more. So higher variable expenses are budgeted for commission and freight. And again, no changes to your total fixed. So in essence, after your 4 quarters are done, you need $180,000 budgeted for your selling and administrative areas. Okay. And that illustration 911 is very good. So now that you know, basically those are all your operating budgets. Okay, those are all your operating budgets. So now that you know what your expected sales are and what your expected expenses are, you can do something called a budgeted income statement. Okay. So it's basically an end product of all these operating budgets that we just went over in the last couple of objectives here. So what the budgeted income statement does is it tells us based on what we've projected, this is our expected profitability, and we can use that to, again, evaluate how we're doing. And again, your sales budget certainly will give you the sales revenue, and all your other budgets will give you all your expenses. And so if you know your revenue and expenses, you can do this. So one thing that's interesting though is, of course, you have to calculate your cost of goods sold, which isn't given to you automatically. This is something that we have to find out. And that basically is the costs of direct materials, direct labor, and manufacturing overhead per unit of this right tied product that we're having. So each right tied product takes 2 pounds of direct materials. We know that from looking at the budget, direct materials budget, at $4 per pound. So 2 pounds would give us a cost of materials of $8. We know from the direct labor budget, which is illustration 9.9, it takes 2 hours to build one of these units at $10 per hour. So we have $20 of labor costs per unit. And we know from the budget illustration 9-10 that the overhead is based on labor hours. So if it takes 2 hours of labor, it's also going to take 2 hours for manufacturing overhead at $8 per unit, $16. So the cost of goods sold for one unit of ride is $44. That's important because if we know how much we're going to sell in terms of units, we can also calculate our cost of goods sold because now we've simply broken down what the cost of goods sold is. So this illustration tells you how to get the cost of each good that will be sold. Okay. So then if you're expecting to sell 15,000 units over the course of that year, and each of these units has a cost of goods sold of $44, which you just calculated, then your cost of goods sold is going to total 660,000, and you need that for your budgeted income statement. So here's your budgeted income statement. Okay. As income statements go, right? Sales are the first line. So we know we were going to, if you look at the budget, that's based on illustration 9.3. We knew that our sales, expected sales for the year, again, this is going to be for the year ending December 31st, $900,000 is your total sales. That's what you're expecting from that. We just calculated what the cost of goods sold are to sell all those units. And that's why it's important because, again, remember, we are manufacturing very much like in merchandising industry, retail. We're going to calculate a gross profit, right? We're going to follow, in essence, that multi-step income statement that you learned in financial accounting. So the gross profit is $240,000. Not bad. We subtract out all of our selling and administrative expenses, right? Our operating expenses, which we get that total from the operating selling and administrative operating budget that we looked at. The total was 180,000. So that gives us our income from operations. Remember, from the multi-step income statement, profit from operations is $60,000. Now we need a little bit of other details that that they provide here. So some of the data that we need once we know what the profit is from operations is, first of all, did they have any expenses? So here they have other expense. The interest expense is going to be $100. So we subtract out the interest expense and then we get our profit before income tax. The second thing we need to know is either the income tax rate or the amount of income tax. And here it's $12,000 that we will subtract out as income tax expense. And bada bing, bada boom, we have a net profit, net income of 47,900. That's the expected net profit at the end of that period of time based on all these budgets. Fascinating. I know. Okay, so we use all of these budgets except for, well, we haven't gotten to those capital expenditure budgets yet. We've only been doing operating budgets. So sales budget, direct labor, selling administrative are all operating budgets. Okay. All right, so we have come to the end of the learning objective 3. And again, there's a lot to it. It's a step-by-step type of process. Again, I don't think it's like exceptionally difficult, but it's really time consuming. Okay. So here we have Soriano Company. Let's hope they don't strike out. They have, they're preparing their budgeted income statement for the year 2017. Relevant data pertaining to its sales budgets, production budgets, direct materials budgets can be found on the following slide. Isn't that nice? So other things we need to know. Soriano budgets a half an hour of direct labor per unit. Labor costs are $15 an hour. Manufacturing overhead, $25 per direct labor hour. Okay. It's budgeted selling and administrative expenses in total, 12 million bucks. So they're not even going to give us a budget. They're just going to tell you what the total of that is. So they want you to do two things. First of all, calculate the budgeted total unit cost. And then secondly, prepare the budgeted income statement. All right. So again, remember they give us some very interesting information that we kind of need. So here's some additional information for Soriano in order to solve this particular issue. First of all, the sales are going to be 1.2 million units. Okay. So quarterly sales are 20% for the first quarter, 25% for the second quarter, 30% for the third quarter, and 25% for the fourth quarter, respectively. Okay. Okay. And the sales price is $50 a unit for the first 3 quarters, 55 for the fourth quarter. They have information on production and direct materials as well. Why does this look extremely familiar? I think we already done this in one way, shape, or form. I wouldn't be surprised. So the first thing they want us to do is to calculate the unit cost. Okay. And so for 1 unit, we need 3 pounds of direct materials at $5. We need a half an hour of direct labor at $15. And we need a half an hour of manufacturing overhead at $25. So each of these units basically have a cost to them of $35. We expect to sell 1.2 million units at I think it was $50 a piece, or was it 655? Oh, it was 50 and then 55. So total amount is 61,500,000 total. Okay. The cost of goods sold, while we sold 1.2 million units, and we just calculated the cost of goods sold at $35 a unit. So our cost of goods sold is 42 million. Okay. That means that our gross profit is the difference, 19,500,000. They gave us the selling administrative expenses already as a $12 million block of a chunk of change. So we subtract that out, and that gives us a net income of $7.5 million. Okay. I think it looked familiar to me because it's the same numbers that we did in Learning Objective 2 together. So I'm a little slow today. My apologies. Questions? Learning Objective 4 introduces you to a cash budget. Okay. And a cash budget is very, very important because we have to anticipate how much cash is coming in during any particular quarter and how much cash is going out, and what's needed. If we didn't have enough cash to go out, we need to borrow money. So basically, a cash budget has three very important sections that you have to know. It's going to show basically how much cash we are expecting to receive in a particular quarter, how much cash we are expected to use or disperse in a particular quarter. And if there's not enough money to cover all of that and give us some money in the bank, we might need to borrow. Okay. And that's your financing thing. If, for instance, if we're borrowing it in one quarter, we're probably paying it back in the next quarter. These borrowings tend to be very short term when we're covering cash budget shortfalls here. And the cash budget, of course, shows your beginning cash and your ending cash. Okay. And that ending cash, of course, as you know, is going to end up on the balance sheet. All right. So this is for any company. Has anyone ever been there? I think I have. And this is the basics of a cash budget. You start off with the beginning amount of cash you have. Right? You're adding into it all the cash you expect to receive in that period of time. That'll give you the total available cash you have for that period. Then you subtract out your disbursements, right? Any bills and other things that you expect to need cash to pay that's going out. So those are your disbursements. Does that leave you with anything left? Usually there is an excess of cash. Sometimes there is not. Sometimes there's a deficiency. There's a deficit of there. So, and even if it was an excess amount, businesses are pretty peculiar about having enough cash in their bank account. So they tend to want to have a minimum amount of money in their bank account. So even though it might look like they have money, it might not be enough. So they might need to borrow. So the financing piece is going to be an interesting one to watch here. And that gives you your ending balance at the end of a quarter, or of course, this is done every quarter and for the year. So this illustration here on what a cash budget looks like is an important one. Okay, so again, cash receipts. Usually, companies are getting cash from selling things. So the principal source of cash for companies is going to be their sales revenue. However, they do sometimes collect cash in other ways. Sometimes they might have interest or dividends, as this says. Sometimes they might have already decided to sell a particular asset of theirs and they're going to get cash for the sale of that. Sometimes they might raise money from stock, issuing stock, and that cash is coming in. So, there may be some things going on there, but most of the time, you're just going to look at what's coming in from revenue. Cash disbursements, again, cash payments that are going out during that period of time. And of course, you need cash to pay for, I would say, almost all of your expenses, with the exception of depreciation, right? You're going to need to pay out cash for all those things. The financing section is really about meeting those needs. Sometimes you need to borrow money. And so the financing section will sometimes show the need to borrow some money. If you're borrowing money in one quarter, you're going to be paying it back usually in the next quarter. And so you need to budget for that as well, showing the repayment of that. Of course, you're not just repaying the funds, you're also repaying it with interest. So that means you need more cash. So we're preparing this in sequence. We actually, our cash budgets are done on a monthly basis. I think the book here gives you more quarterly basis type of stuff. Um, and it's really, really important to make sure that every company is effectively managing the cash that they have, and cash budgets allow them to do that. So here we go. Here's our illustration of our cash budget. Again, we're sticking with Hayes. Okay. Cash balance is expected to be on January the 1st, by the way. $38,000 is going to be their starting balance. Now, here's the policy that I was talking about. They wish to maintain a minimum of $15,000 in their account at all times. So that's one of the numbers that becomes a floor. They never want the balance to go below 15,000. If it's below 15,000, they got to borrow to bring it back up to 15,000 or more. Part two is the sales data. Again, we're using our sales budget, illustration 9.3. We collect 60% of the money in the quarter that's these things are sold. And the additional 40% of it is collected in the following quarter. Okay. Accounts receivable at the end of December of the previous year was 60,000. So again, that's, and it's going to be expected to be collected in full in that first quarter in January. So again, we're starting our budget on January the 1st. This is the leftover from the previous quarter. Short-term investments are expected to be sold for $2,000 cash in the first quarter. So they're going to be getting some additional money coming in the first quarter only. They have to buy direct materials, as you know, from the budget that's in illustration 9.7. When they do buy direct materials, 50% of the costs are paid when it's purchased. The other 50% are paid in the following quarter. So accounts payable at the end of last year was $10,600, which of course has to be paid in full in the first quarter of this year. Direct labor, 100% is paid when it happens. Again, for manufacturing overhead, selling, administrative expenses, they're always paid in the quarter that they happened. The exception is depreciation here. A little bit more information here. They want to buy a truck in the second quarter, and they're going to need $10,000 cash to buy that truck. So that's a need for cash in the second quarter. Hayes makes equal quarterly payments of its income taxes. Okay. And that's true for every business. They're supposed to be filing every quarter their estimated income tax. In terms of loans, they have to repay a loan. They repay those loans as quickly as they can, as long as their cash minimum is 15 grand. They will pay the loan back. So all that information is needed to prepare a few things. So first, we're going to prepare a schedule of collections from our customers. So again, we are expected to, we collect 60% of the money from sales in this quarter, 40% in the next. So remember, in the previous quarter, they had accounts receivable, which is all going to be coming in. So these are basically going to be cash collections. In the first quarter, they're going to collect the cash that was due last year, which was the 60,000 in receivables. Plus, they're going to collect 60% of their first quarter sales, which should be 108, sorry, 60%. So that means that they will collect $168,000 in cash from customers in the first quarter. In the second quarter, again, they're going to be collecting the rest of this. Right? And 60% of their second quarter sales they will be collecting in cash. So that means in the second quarter, they'll be collecting $198,000 in cash. In the third quarter, they're going to be collecting the rest of this. So it's 84,000, plus they'll be collecting 60% of their third quarter sales of 144,000. So they're going to be grabbing 228,000 in cash in the third quarter. In the fourth quarter, they're going to be collecting the rest of their third quarter sales, and they're going to be collecting 60% of their fourth quarter sales. So they'll have 258,000 in cash coming in. So these are all the collections from their expected sales. Okay. In terms of the payments for direct materials, remember they do half and half, if I remember correctly, right? So in this case, they do have an outstanding accounts payable that they gave you information on. So they're going to be paying all of that in this quarter and half of their purchases for the first quarter here. So they're going to need to fork out $23,200. They need cash to pay those bills for direct materials. In the second quarter, they'll pay the other half of their first quarter, plus they need to pay half of the second quarter materials. And so they're going to need $27,200 in cash to pay out for those. Third quarter, again, the other half of the second quarter and the first half of the third quarter. They'll need $31,200 to do that. And the fourth quarter wraps that up. So their total payments, that's just for direct materials, because they pay it half and half in the quarter that it's happening and the other half in the next quarter. You sort of have to see where those payments are needed, so you can calculate how much cash is needed each quarter. Again, not terribly difficult, but time consuming. So what does that leave you with? That leaves you with what a cash budget looks like. Okay. So we are doing a few things. We are looking at this quarter to quarter. So let's just focus on quarter one right now. We were told that the beginning balance is 38,000. So this 38,000 came from the beginning balance we were given in the problem. Okay. We are going to be adding in the cash receipts. So the cash receipts would be the $168,000 that we expect to collect from customers. Remember, we did that collection budget. So that's cash coming in. Plus, remember, they sold those $2,000 worth of securities that they're going to be collecting as well. So they'll get this $2,000 extra in the first quarter only. So that means they are going to have $170,000 of new cash coming in addition to the $38,000 they started with. So that means they have $208,000 of cash available in the first quarter. Well, how much do they need? Is all these disbursements. Again, we did direct materials for the first quarter was 23 $1,200. Direct labor is paid when it's happening. We needed 62,000 for that. Manufacturing overhead is paid as it's happening, minus depreciation. Okay, so that's another little factor here. $53,300. Selling and administrative expenses, again, minus depreciation, 41,000. We're not buying a truck in the first quarter, but we will later on. And we are going to spread our income tax expense evenly, $12,000 for the year, $3,000 each quarter. So we're going to need to fork out $182,500 in cash. That leaves us $25,500 left when we compare these. And thus, that is much more than our 15,000. So we are okay ending our quarter with that balance. The ending balance for quarter one is your beginning balance for quarter two. That's how much cash you're starting with in quarter two. You add in the collections from customers that you're expecting. You're not expecting anything else other than those collections. So between what you're starting with and what you're expecting, you'll have $223,500 available in cash for the second quarter. You'll need to pay out for direct materials, direct labor, manufacturing overhead, again, minus that depreciation, selling and administrative expenses. Okay. So also for the second quarter, that's where you're going to need to purchase that truck. So you're going to need an extra 10 grand on hand in cash to buy that truck. Plus you need to pay for your taxes. So now you're going to need $211,500. So if you take the difference between your 223 and your 211, you'll have a $12,000 difference. That is below what they'd like. Remember, they want to make sure they have at least $15,000 in their bank account. So they're going to borrow $3,000 to bring that 12 up to 15. This $15,000 at the end of the second quarter begins your beginning balance in the third quarter, adding in what you're going to be collecting from customers, totaling those two up. Again, listing all the cash you need to take care of all of your expenses from your budget. Excuse me. Means you're going to need $220,000 in cash. We're going to leave you with $22,500 more than what you need. That means you can pay back the loan. So in this case, you're paying back the loan with $100 of interest. So you need $3,100 to pay that loan back. And you're still going to have $19,400 at the end of that quarter, which is again above the $15,000. So you're okay. That $19,400 becomes your beginning cash in the fourth quarter. Again, you're adding in the cash you're expecting to collect, total amount of cash you have, total amount of cash you need, and the difference. So at the end of the fourth quarter, you're going to have $37,900. This ending cash balance in the fourth quarter is going to be on your balance sheet for December 31st. That's what your cash is going to be. Okay. So why is it going to be on your balance sheet? Well, because they do what's called a budgeted balance sheet. Okay, so they have lots of plans clearly for the year, right? You saw that. But did you also know they have other plans other than what you've seen, including doing things with their equipment and maybe raising more money in stock or doing other types of things. So let's look at some data that's important to remember when we're putting together something called a budgeted balance sheet. It's going to be all based on these budgets and plans that they have. So at the end of December 31st, 2016, right, these were the balances in the accounts. We are going to be doing a budgeted balance sheet for 2017, December 31st, 2017, a year later. So clearly there's going to be changes in some of these accounts, as you'll see. Okay. What you will notice here is that the budgeted balance sheet for December 31st, 2017 has the ending cash balance that I pointed out to you from the cash budget. Okay, you will see that as the um, ending cash there. So that's important. Another thing to remember too is that your accounts receivable is 108,000. That's going to be coming from the fact that you're still waiting to receive 40% of the customer's money from the last quarter. Remember, when you sell to customers, you collect 60% in the same quarter. You collect 40% in the next quarter. So 40% of the fourth quarter's sales that you're expecting is 108,000. That becomes part of your receivable because you'll be receiving that in the early part of 2018. Your finished goods inventory is going to be part of your budget, your production budget. You're going to see on your production budget, you had 1,000 units left in inventory. And these 1,000 units that you had left in inventory had a cost of $44 each. So there's $44,000 sitting in finished goods inventory. When you looked at your raw materials budget, you also saw that there were 1,020 pounds of raw materials left over. And these pounds cost $4 a piece. So $4 times 1,020 pounds gives you raw materials of $4,080. So this is how they calculate their current assets on the budgeted balance sheet. What they know from those budgets goes on here. Property, plant, and equipment, always fun. So the property, plant, and equipment, as you remember, ended 2016 with $182,000 of buildings and equipment, but we bought a $10,000 truck in the budget. And so now we have $192,000 worth of buildings and equipment. A truck is equipment, so that's where the $10,000 would go. You probably also remember too that there was some depreciation expenses that were listed. So accumulated depreciation in this case, we had $15,200 in your manufacturing overhead budget. If you looked at your manufacturing overhead budget for depreciation expense, you'd see 15,200. And if you looked in your selling and administrative expense budget, you'll see depreciation expense of another 4,000. So you would add that to the beginning balance and accumulated depreciation that they gave you in the first slide, and that's where that 48,000 comes in. Okay. Book value 144. Total assets are your current assets plus your property, plant, and equipment. Okay. How much fun? How much fun is this? That's why I said you're going to probably need the weekend. Cancel all your plans. For the liabilities, your accounts payable, remember 50% of your purchases in the fourth quarter, you pay for direct materials, you pay half of it now, you pay half of it in the next quarter. So that's the half that you still owe from the fourth quarter's direct materials. Okay. Common stock had no change. You didn't issue any stock or anything. But your retained earnings did change. Why did it change? Well, because you are projecting net income of another $47,900. from your budgeted income statement. You add that to the balance in retained earnings that's already given to you from 2016, and that's where that came from. So your liabilities and your total stockholders' equity will also total up to 337,980. How much fun is this? Okay, so again, this explains what you just saw. These were the ending balances in 2016. Right, buildings and equipment were 182, common stock 225, accumulated depreciation was 28.8, and retained earnings was 46,480. These are the accounts I was telling you were tweaked by the fact that we bought the truck. The fact that when you look at your budget, you'll see depreciation expense two places. You'll see it first in manufacturing overhead budget. You'll see it second in selling and administrative expense budget. Put those together, add it to that. Retained earnings, that's the beginning balance. We just projected we had another profit. Add those together. That's the retained earnings balance. So cash is easy, right? That you know where that 37.9 came from, the cash budget. Accounts receivable, again, it tells you that we, when we make sales, we collect 60% of the sales in cash in the quarter that it happened and 40% of the sales in the next quarter. So we're still waiting for 40% of the sales from the fourth quarter. That's why it's in accounts receivable. Finished goods inventory, as I mentioned earlier, you had desired ending inventory in your production budget of 1,000 units. And you know, based on your costs, that each of those is 44 bucks cost of goods sold. So 1,000 times 44 is the $44,000 of finished goods inventory. You also have raw materials inventory. If you look at your raw material budget, you'll have 1,020 pounds of raw materials left as your ending inventory, $4 a pound. That's where that came from. Again, the buildings and equipment account, I told you it started as 182, but you bought a truck for 10,000. That's why it's 192. Your accumulated depreciation account had a balance of $28,800 at the end of 2016. But if you look at your manufacturing overhead budget, you'll notice your total depreciation is $15,200. You're going to add that. If you look at your selling and administrative budget, $4,000 of depreciation is there. You're going to add that. So that's where your accumulated depreciation comes from. Your accounts payable is, again, the way we do our direct materials. We pay half of it in the quarter now. We pay the rest in the next quarter. Well, at the end of the year, you're going to owe 50% of that quarter, that fourth quarter. So that's your payable. No change in common stock. But as you know, retained earnings had a balance of 46,480. But you just showed in your budgeted income statement that you think you're going to have a $47,900 profit. So you're going to add those together. And that's how we would do a balanced, that's how we would do a budgeted balance sheet. Okay. So learning objective 4, there's a lot there. There's a lot. This is a lot. This is going to take you the weekend. So we have Martian Company. Sounds out of this world. They like to maintain a cash balance of $15,000. At the beginning of March, they had a cash balance of $16,005. They're expecting cash receipts of $210, cash disbursements of $220. So how much cash must be borrowed if they need to maintain it? Well, again, they start with $16,500. They want to make sure they have at least $15,000 at the end of the month. We're going to add to that cash receipts in March. So we're going to have $226,500 in total, but we need $220,000 in disbursements. So that leaves us with $6,500. That's well below where we want to be. So we're going to have to borrow the rest. That's the show. But any questions on? Could you follow where I'm getting that information, where that information is being pulled from? It's not a separate thing. You have to look at the previous budgets to find those numbers. Okay, so that's the trick here. Questions?